Gary Bradshaw, one stock you like in the Hodges Small Cap Fund is Brinker. They own the Chili's restaurants. So why do you like this restaurant chain as opposed to so many other restaurant stocks that are out there?
Greg, we think Brinker's a great buy today. They have revamped and remodeled their stores. They've revamped their menu, and it's driving their same-store sales growth. It's up 2 to 3%. We think it will continue, and it's going to drive their earnings. We think the stock is cheap, trading about 15 times this year's earnings, and those earnings will grow 15 or 16% a year. And we really love the fact that Brinker is buying in a ton of their own stock with their free cash flow. Actually, over the last 10 years, they bought in 50% of their stock. So we think earnings are going to increase, the same-store sales are increased, and it's a cheap restaurant stock. And with energy prices down, we think they'll stay lower for longer. The consumer has more money in his pocket. He's going to go out to eat at a lot of these restaurants.
And you're also bullish on Cracker Barrel. Now, this stock's been flat in 2015 so far after a great 2014. So what takes it higher?
Cracker Barrel has 635 stores along the interstate highway. With these gasoline prices down, we think the consumer's going to drive more. And they had a fabulous last quarter with 7% positive same-store sales growth. We think that continues. There's a good cheap meal at Cracker Barrel while people are out driving. We think their earnings will grow 16 or 17%, and we think the stock will continue to move up. They pay a 2.85% dividend. Just inexpensive restaurant stock that should do better as a consumer gets better.
And you're also positive on Pilgrim's Pride. This stock's down around 10% in the past week. Worries about bird flu surround it. Why do you like it?
Pilgrim's Pride is a little controversial, and it's unfortunate what's happened with the bird flu, but Pilgrim's Pride grows broiler chickens, and that part of the market has not been affected by the bird flu. It's mostly been in egg-laying chickens and turkeys. So there's 8.5 billion broiler chickens grown a year, and that's the area that Pilgrim's Pride competes in. And this stock is dirt cheap. Beef prices are still sky high. Corn prices, soybean prices are down, so their costs are down. And the stock only trades at about 7.5 times earnings. We think people will eat more chicken with higher beef prices, and the stock looks very inexpensive to us.
And then finally, you're a fan of Casey's General Stores. This is a Midwestern convenience store owner. Stock's done great in the past year, up over 25%. So tell me about Casey's.
Casey's has 1,850 convenience stores, as you mentioned, based in Des Moines, Iowa. Their stores are in 14 Midwestern states, and folks are going to Casey's more, not only to fill up, but they make and serve great pizzas, donuts, hamburgers, sandwiches, and that's what's driving Casey's same-store sales. So the consumer's spending more as he's paying less for gasoline. He's got more money in his pocket. And Casey's is a great business in spite of the consumer spending more. They own all the real estate under those 1,850 stores. They'll grow that store base by 100 more convenience stores each year. And we think with positive same-store sales, lower gasoline prices, we think earnings go up.
All right, thanks a lot, Gary.
Thanks for having me, Greg.
And thank you for watching The Street.